As I started slightly increasing my ELF position, we received some news that I absolutely didn't want to see. As in all honesty, it reminds me of the warnings we got from Celsius right before this incredible drop happened. From $96 all the way down to $31. Now, we also had something happening around PayPal that I just quickly want to touch on before moving to the disaster that were the Nike earnings, as they were just straight up painful. But if you gain some new insights from my video, make sure to subscribe to my channel as I post new videos every Monday, Wednesday, and Friday. Now, with that being said, let's just dive straight into, well, ELF Beauty. Because ELF Beauty stock value is significantly lower as slowing sales backdrop weighs, Morgan Stanley says. Now, this is an article that just goes over the lowering of the price target that Morgan Stanley has for ELF Beauty, but it touches on some quite important points. Now, I have my warning signs out there for ELF Beauty. I think there are major red flags for this company, but I think that they also have a lot of growth. So I'm weighing the positives with the negatives. But let's just look. Because ELF Beauty stock value has significantly declined amid an unexpected slowdown in the US scanner data, which is the sales data from retail outlets in the US, Morgan Stanley said in a note on Monday. Now, growth is heavily concentrated in the lipstick category, which accounts for half of the company's quarter-to-date growth, raising concerns about the broader portfolio's performance, Morgan Stanley noted. Now, this is really important because I have mentioned this before. ELF Beauty growth is slowing down. And of course, this comes with the larger numbers in revenue, but it is slowing down. And this is also what we saw with Celsius. Now, of course, those two business models are not truly comparable. ELF Beauty works in a way different manner than Celsius does, because ELF Beauty doesn't sell predominantly to one large customer. But still, sales data is sales data, and it is slowing down. Now, ELF Beauty's revenue expectations for Q2 and H2 remain beatable due to the strength outside of the US, but there is still concern about the long-term growth potential, the investment firm said. Morgan Stanley maintained an equal weight rating for ELF Beauty while reducing the price target to $139 from $184. So that's a substantial cut in price target. And I think with this news, that might be quite justified. Now, I know this is not what you want to hear, but I am just being honest here. So let's just once again dive quickly into the facts of this business. We have a next 12-month PE of 29.8, which has been coming down, of course, because the price has come down so much. We have sales estimates for fiscal 2025 of 1.32 billion. Next year, we are expecting 18% growth and the year thereafter 17.57%. We see EPS growth of 10%, 26%, and 26.5%. And all in all, that isn't all too unhealthy. That is good growth. However, it has been massively slowing down. Now, this slowdown may be best visualized by the trailing 12-month or the last 12-month quarter-over-quarter growth rate. Because we see that the mean is 8.6 and we are still above it with 10.56. However, when we look, we can see right here we are around that 15%, around that 16.5%. Quarter prior, we are just about 14%. So all in all, we are slowing down. The last quarter, we had the same growth, was this one, and that were the earnings of January 2023. So well over 1.5 years ago. So we are slowing down in revenue growth. I've made this point very clear, I think, in my prior videos. And I made 2 videos in which I explained what my issues were with this stock. Now, this is one of them, of course. Now, if we look at ELF Beauty, we know that most of the growth is coming from the past 5 years. So this is also what I adjusted this chart to, the last 5 years. And we can see that the EPS for a mean forward PE, next 12-month forward PE basically, has been 42.9. This is the last 5-year average. Right now we are at 29.8. So in all honesty, that looks cheap, right? But over the last 5 years, growth has been improving, not deteriorating. And besides the growth deteriorating, there is one more thing. Now, besides earnings coming down, we have the balance sheet, which is also not looking all too great. Now, this is their own table, the PDF of their own earnings release. So I can't use my paint skills here with the arrows and stuff. So I will just take you from the top to the bottom. But when we look at the top, we have the assets, the current assets, and the cash and cash equivalents. Now, this has come down significantly over the past year. There has been an acquisition in between that will play a part of this, but it has been coming down. However, we do see the accounts receivable going up very rapidly by about, 65 million. So what is that? 70% or so? Now we have the inventories that's gone up by double. Now their revenues haven't increased or doubled, so this is not good. You don't want the inventories and the accounts receivable overgrowing or growing at a faster clip than their revenues, because that means that they just got a bunch of inventories on their hands, or people are not paying them, basically. Now, the accounts receivables is not a perfect measure in and of itself, but it is something to look at, right? When we then look further, we have the goodwill, and this is why you also see that acquisition coming in, right? Like a year ago, it was 170 million. Right now, it's 340 million. So this is a big boost to their total assets. We can see that. Now, when we go to the liabilities, we can see that they have a current portion of long-term debt and financing or finance lease obligations of 103 million. So that is almost equal to their cash expense. Not ideal. Not ideal. The total current liabilities are 300 million, and they have a long-term debt of 160 million. But once again, this also includes debt acquisition. So that's nothing too much to worry about, or nothing to be too concerned about this jumping up. Now, what might be good to look at, however, is their cash flow statement. Because we can see, and basically the only thing I want to highlight here is the bottom part of this table. And this is the cash and cash equivalents beginning of the period. And this is the second to lowest part right here. And that is 108 million. At the end of the period, 109 million. So the net increase in cash and cash equivalents was 851,000. Now, this is not all too great. And I've highlighted this before, but the reason I'm highlighting this is because of what they are doing. And that is because of this announcement they made. Now, I've highlighted this before, I know. But Elf Beauty has approved a 500 million share repurchase program. They did this as they had a $25 million buyback authorized in 2019, which was completed following the repurchase of $17 million in stock in the past 2 weeks. That was as of reporting this on August 27. However, we saw that in the prior quarter, they had $851,000 of free cash flow, and now they are repurchasing shares with 17 million. So that cash position, but that isn't looking all too great then. And they accepted, or they authorized a $500 million program. Now, in my opinion, that's not good policy. That's not being a good steward of cash. Of course, the company has a lot of growth, and they can pull several levers in order to increase that cash flow, increase the profitability on an EPS matter. But I don't like it. I don't like this. So as the table of my holdings currently looks like this, and Elf Beauty is my smallest holding at 2.7%, I said that I wanted to increase it to around, this area, right? With Shopify and Celsius, around that 5 to 5.5% weighting in my portfolio. Now I'm having doubts. Because of that slowdown in scanner data, we saw this with Celsius. Once again, I'm not saying they are the same, but this is not really good news, right? This isn't really the news you want to hear. What makes it easy for me is that I have a cash weighting of about 10% right now. I have bought some stock in the past week, but I'm still at about $500 of cash, which I can just deploy whenever I feel like it. Now, then there was some news regarding PayPal, because PayPal in January launched their first look, their first updates, and they were not received that positively. I mean, when we zoom into their stock chart, right, it was around here that they announced it. the stock shooted upwards, and this was the actual release. The stock immediately plummeted. From the open on January 22nd, we saw it go down to, well, basically a low of $58. It was down almost 15% in the few days after. And then, of course, we had the earnings report, which also made the stock plummet even more. But still, it went below $60 after the release. Now, luckily, ever since then, the stock has recovered and we are now shooting upwards. So what happened? Alex Chris joined Yahoo Finance for the opening bid, and in this he explained about his first year and his priorities in that first year. And what he said was that he was extremely focused on velocity, completely changing around the management team and increasing the rate of innovation. This is the message he's been giving us, well, basically all throughout this first year, but he repeated it once again over there. And we can see this pay off, right? We see Fastlane, we see the ads platform coming, all the things I have been completely and repeatedly telling you guys about. This is also being recognized because on September 30th, we had New Street adjusting the price target from $85 to $100. On September 27th, we had Barclays adjusting price target to 92 from 90 or $85. And the list goes on and on. Also right here, September 23rd to $94 from $74 by Deutsche Bank. I mean, it keeps improving, right? We also now, call it fortunately, call it unfortunately, it's up to you to decide. We have Cathie Wood investing $4.5 million into PayPal. I mean, the story is getting recognized right now. And if you've been a shareholder for longer or a longer period, then it's finally happening. The turnaround finally seems to get acknowledged. For me, at least, that is very nice. I've been in this stock for some over a year now. I think August last year, August 23, I first started buying this company. I mean, I have my position built in this stock for almost 9 months now. For me, it was just waiting for the recognition to come. Now then it's time to look at this one, Nike. And Nike was down, or is down right now, 5% in pre-market trading after the company released their the fiscal Q1 earnings report. And this was bad. I mean, this was really bad. Listening to their opening of the earnings call, it almost sounded like they have just pinned this guy down for their new CEO role in the hope that he can turn this play around, because it almost sounded as if the CFO just didn't know what to do anymore. In my opinion, this was really, really bad. Now, they were looking for highlights, they found some, but all in all, everything was down across the board. So let's just quickly look at it, because they started their earnings release with this statement. Given our CEO transition and with 3 quarters left in the fiscal year, we are withdrawing our full year guidance. We intend to provide quarterly guidance for the balance of the fiscal year. This provides Elliott with the flexibility to reconnect with our employees and teams, evaluate the current strategies and business trends, and develop our plans to best position the business for fiscal 26 and beyond. To that end, we have also decided to postpone our Investor Day. Now, the last part isn't that surprising. I mean, an Investor Day right after you transition from CEO. I mean, he has to get reconnected with this business, right? So you shouldn't be worried about that part. That's completely normal, because what does he want to present at the Investor Day? The guy that I'm supposed to replace has done all these things, which clearly did not work. And I've been brought in to improve on it, but I have no improvement points yet because I just have not been here for long enough. Postponing the Investor Day isn't anything to worry about, in my opinion. Earnings, however, they are. Because, of course, they presented this as the next chapter of growth. I mean, this is just the next chapter of getting the business back up and running. I mean, I don't want to be all too negative, but if we look at the income statement, we can see revenues down 10%. Now, the good thing is that the cost of sales was down 12%, and the gross profit therefore was only down 8%. Their gross margins improved from 44.2% to 45.4%. The gross margin improving, that's very positive, of course. Now, they attributed this to shipping, for one, and a few other things, but the demand creation expense was up 15%. So revenue's down 10, but basically marketing is up 15. Now, the operating overhead expense down 7%, so also down less than the revenues. And the total selling and administrative expenses were only down 2%. Not ideal. Let's just keep it at not ideal. Completely, totally not ideal. Now, the income before income taxes was 1.3 billion compared to 1.6 billion last year, down 21%. Down 21%. That income before income taxes. That's just really painful. Now, then they also had a higher effective tax rate, which didn't help for their net income, of course. And this was actually a bunch higher. So they're minus 28% in net income. Sure, that looks absolutely terrible. But they also had a way higher effective tax rate. So, I mean, I guess that's not all too much within their control. Now, there are, of course, a few parts that they can toggle with. But I mean, they just had a higher tax rate, right? I mean, yeah. Now, the income per common share was down 26%, down from 94% on a dilutive basis to 70 cents right now. It's just not great. It's just looking bad across the board here. Now, while doing this, they do have higher dividends. So last year they had a dividend per common share of 34 cents, right now of 37 cents. I don't know why you would increase the dividend when your income looks like this. The only reason I can say is to make sure you keep increasing it, and that looks good. But nothing about this income statement looks good. Like, nothing. So when we continue to the balance sheet, we can see the cash and cash equivalents up 37% or about 2.3 billion. Now, of that 2.3 billion, I would say about, 800 million comes from the short-term investments, because that is down 800 million. Now, if we then continue, we see the inventory is down 5%, but revenues were down 10%. So, yeah, I mean, revenues coming down or inventories coming down slightly, good, but not as much as revenue. Now, when we then continue to their liabilities, we see that the current portion of long-term debt is now 1 billion. So 1 billion has been taken off the long-term debt. And we can see that is pretty much right. That pretty much equals out there. And now we have the shareholders' equity, which is flat. So there is no growth in the balance sheet, but there is contraction in the earnings. So maybe it's good that they somewhat delivered on the balance sheet, but the income statement was just simply terrible. Now, if we then look at the divisional revenues for North America, we can see footwear down 14%, we can see apparel down 10%, but equipment up 34%. For the Europe, Middle East, and Africa, the EMEA, we see footwear down 12%, apparel down 11%. We see in Greater China, footwear only down 2%. So I guess that is somewhat of a good point, right? I mean, down 2% compared to all the other parts, that's not bad. We see apparel down 9%, and we see equipment up 29%. Now, this is a very low base, but still up 29%. I guess that is very positive in this story right here. Now, when we then look at Asia Pacific and Latin America, we see footwear down 3%. But that is excluding currency changes, and otherwise it'd be down 8%. We see apparel down 6%, and the equipment being up 3%, or excluding currency changes, up 9%. Not too bad. Okay. But then we see the total Nike revenues, excluding currency changes, being down 9%, and just including currency, we see it down 10%. So, Yeah, I mean, the stock is down 5% in pre-market trading. And in all honesty, my honest opinion is because, well, I guess investors were expecting even worse than this. I mean, it's Nike, right? They have their brand, which they can always leverage. But these earnings, they are absolutely terrible. And with that being said, I want to thank you for watching my video. If you've liked my video and got some new insights, please make sure to subscribe to my channel. And I hope to see you in my next video.